Welcome back to Trader UK, the money management channel. Today I want to look at withholding tax on foreign dividends and in particular US withholding tax. I'm going to take a quick look at form W8-BEN and its importance for investors outside the United States. I'll explain to you how those nasty withholding taxes work on your foreign dividends that you receive, and then we'll look at the best way to deal with them. Before we get going today, I'm sure you know how it works, but if you could smash that like button for me, I would be hugely grateful. And don't forget to subscribe if you want more similar content. Just note that I'm actually from the UK. Make sure you're checking your local tax laws if you're watching from elsewhere. You should find that the principles tend to be fairly similar, at least when we're looking at dividend tax. Now, most of us like to invest in foreign companies, and this is made very easy nowadays by trading apps that give us access to markets worldwide. Of course, the most popular markets lie in the US. This is where you'll find Microsoft, Google, Amazon, Tesla, Facebook, big recognizable companies that retail investors like to hold in their portfolios. But unfortunately, when we invest in US companies, the tax law can actually become a little bit tricky, which in fairness is what you would expect as a non-resident. I know that if I wanted to buy a house in the US or a car in the US, there would be paperwork and legislation that I'd need to get past first. I myself am a UK resident, but some of my assets are shares in US companies, which means that any income that those assets generate can be subject to both UK and US tax. The UK tax I am responsible for reporting myself, but the US tax is deducted at source, and this is why you'll often see a deduction alongside any foreign dividends that you receive. The standard rate for US withholding tax on dividends is 30%, which means that if a US company wants to pay you a $100 dividend, you'll only actually receive $70 of it. The other $30 is withheld at source, which is actually a big chunk of your income. Fortunately for us, the US has tax treaties with most countries which will entitle most foreign investors to either a reduced rate or exemption from the withholding tax. For example, with the UK, we are entitled to a reduced rate of 15%, but only once you've completed form W8-BEN. This here on screen is form W8-BEN that needs to be submitted to the Inland Revenue Service in order to receive that discounted rate. Fortunately for us in 2020, it's usually our trading account providers that will complete and submit this form for us. However, you need to give them permission to do so first. And if anyone has been paying tax at the higher rate, you can actually make a backdated claim for overpaid tax up to 2 or 3 years. You'll find the full details on the IRS website of how to do so. But of course, it's much easier to get yourself registered via your trading app to make sure all future dividends are taxed at the reduced rate. Now, what about the further 15% that we're still being taxed? Is there any way of getting this reduced or maybe claiming it back? Unfortunately, for the majority of us, the answer is going to be no. I did read through the US-UK double taxation agreement because I have too much time on my hands, and there is a very odd situation where you may be able to get a reduced rate, but it tends to be when you hold very large stakes in US companies, but nothing that would apply to your everyday investor. However, if you incur a further tax liability in the UK, if you're already utilising your £2,000 dividend allowance, then it's that double taxation agreement that allows you to offset the tax that's already been withheld in the US, essentially meaning that you won't be taxed twice. The only caveat with this is that you can only offset the smaller tax amount. So if you are taxed at 7.5% in the UK, you will only be able to offset the 7.5%, which is great because your tax bill in the UK will then be zero, but you're still losing that 7.5% that was also withheld in the US. Whereas if you were taxed at 32.5% in the UK, you can deduct the full 15% and then just pay the difference over to the UK government. To obtain this tax relief, you just need to make a claim via your self-assessment tax return. One thing that foreign investors can do to mitigate their tax burden is to bear this in mind when building their portfolios. If you're buying dividend stocks and you come across 2 stocks, one homegrown, one from the US, both of which pay a dividend yield of 5%, then in terms of cash in your pocket, you're actually going to be better off with your homegrown company. So although we often overlook our own exchanges for the glamour of the S&P 500 and the Nasdaq, it's definitely worth thinking twice in future. That's all for today, guys. Let me know in the comments your favourite UK dividend stocks so I can go and check them out. Make sure you're applying for that reduced withholding tax via the W8 form. Thank you for watching, and I'll see you next time.